Hello and welcome to our discussion of inventory under financial accounting. Specifically, this lecture is covering the perpetual versus periodic inventory methods. So with inventory, there are a couple of sides to this. First of all, we purchase the inventory and then we sell the inventory. So we're going to look at both sides of it. You're going to see discounts, returns, and allowances on both sides. In addition, you're going to see the potential of shipping charges on both sides, either when we buy or when we sell. Now, this lecture is focused around the two different types of inventory systems we could see, periodic and perpetual. And what we're going to see is the difference in how each method is used to record both purchases and sales of that inventory. In other words, for those entries, what's different between periodic and perpetual? Now, this is a quick overview, this first slide. The purchases and sales of inventory under the periodic system are not immediately recorded in the inventory account. Instead, it's only done once per period. It's done on a periodic basis at the end of the year. Once the physical inventory count has been completed, and we know how much inventory we have, we know how much we should have based on all the beginning inventory and the purchases, and we assume whatever's not there must have been sold. So we're going to do that update once per period. With the perpetual inventory system, however, both the purchases and sales of inventory are tracked immediately into the inventory account. There's no delay. We're not waiting until the end of the period. Now, I do want to specify that that's not to say that we would never do a physical inventory count under perpetual. It's just that it's only used for reconciliation purposes rather than the core entry itself. So, under the periodic inventory system, we're going to see an account called the purchases account. And we'll see purchase returns, purchase discounts, purchase allowances. But these are all not the inventory account itself. Now, one way to think about this, it's basically a temporary inventory account. It's not the core inventory account. It's not the normal asset that we would see. Instead, it's just a temporary holding place for the value of the inventory that we just purchased until we can finally reconcile it to determine how did it truly impact our inventory account at the end of the period. So it's an odd type of situation. And what makes it even odder is that different textbooks, different discussions of this show this either as an expense or an asset account. So the thing about that, I prefer to refer to this as an asset so that it makes more sense. It's a temporary asset that eventually will be converted into the inventory account. Some textbooks, however, call this an expense account. And the basic problem with that is that we're assuming that this is all being sold. Because normally under inventory, we don't count something as an expense until it's been sold. We don't count inventory as an expense until it's been sold. So if we treat this purchase account like an expense account, we're kind of accelerating that recognition. We're assuming it's all going to be sold, which may not be the case. So instead, we treat it as an asset temporarily, and then we'll move it over to the inventory account down the road. That's why I prefer to refer to this as an asset. Now, you're also going to see separate accounts for the purchase discounts, returns, and allowances. And again, the same question comes up. Do we call this a contra asset, or do we call this a contra expense account, contra cost of goods sold? In my mind, it's better to refer to this as an asset, a contra asset, because again, none of this is really expense related until we know for sure how much has been sold. But the reason I specify this is that I've seen different textbooks refer to it both ways. And both could technically be considered correct. It's just the timing difference. When was the asset actually sold and converted to an expense? Now, the other thing about a periodic inventory system is when you have the sale itself, you're only going to see the sales revenue side of things. You're not going to see the underlying cost until you do that reconciliation at the end. So you're only going to see a debit to accounts receivable and a credit to sales for the selling price. The entry related to inventory and cost of goods sold is going to be deferred until the end of the period when you do your reconciliation. So let's take a look at an example journal entry for this, for purchase of inventory. you would have a debit to purchases, that temporary account for $2,500, and a credit to either cash or accounts payable, depending on whether you spent cash right away or whether you're going to pay over time. Again, that purchases account takes the temporary place of the inventory account. Now let's say we have a return. So they've returned $500 of inventory from a previous purchase. So they debit cash or accounts payable because they're either getting their money back or their accounts payable is being reduced by $500. And then they credit the purchase returns and allowances account. Now this is a contra purchases account. So whatever you refer to the purchases account as, which again I would prefer asset, so this would make this a contra asset, which offsets it. So the purchase returns and allowances, it offsets that purchases account. So now let's say in this situation we had a purchase discount. We paid early and we were entitled to a purchase discount. Let's just assume it was a $50 discount. I know percentage-wise that's pretty high, but let's just throw out $50 as the amount. The entry for this would be to debit accounts payable to reduce that, to show that it's really not, we're really not owing all that we originally thought we were because we're getting a discount. So we're reducing that liability, and we're crediting purchase discounts. That's just like the returns or allowance. That's another contra purchase account. Now let's say we were required to pay shipping. So for this, we would debit an account known as freight in or transportation in for $75. And we would credit, looks like in this case, actually cash, because we said we were paying cash. This ultimately will add into the purchases account, as we'll see in just a bit. So the net purchases calculation here, we'd have purchases of $2,500 less the purchase returns and allowances of $500 less the discount of $50 plus the freight in of $75 gives us net purchases of $2,025. So let's assume, because we're going to need to know the beginning balance in inventory before we made these purchases. We had $1,000. We made all these purchases netting out to $2,025. And then that tells us we had $3,025 available for sale throughout this period. But in this case, it says we have an ending balance of $300 of inventory after all purchases and sales. That tells us we must have had cost of goods sold of $27.25. We must have sold that much. Now, how we calculated these last two items is actually a topic for another lecture altogether, because that depends on what method we're using, like FIFO, LIFO, weighted average, all of those. So what we'd see here with the journal entry, this is the reconciling journal entry at the end of the period. We would debit inventory for $20.25, debit the purchase returns and allowances, debit the purchase discount to close those out. Remember, they had a credit balance to start with. Now we're debiting them. We're crediting purchases because it started with a debit balance. We need to close it out. We're moving everything over to inventory. Remember, this is the net purchases that's being added into inventory. And we would credit freight in to close that out as well. It started as a debit. We're crediting it to close it. Now notice this is just to move the inventory into the inventory account, move the purchases into the inventory account. Then when we sell it, we would debit cost of goods sold and credit inventory for $27.25 because that's what the sales were. Now normally these two entries would take place at the same point in time. You might even merge them together, but in this case I handled them separately just so you can see what's going on. Now into the perpetual inventory system, the big difference here is that we don't keep a temporary inventory account. It all goes into the normal inventory account. So we would record purchases, returns, discounts, allowances, and freight. They would all be in the inventory. There's no separate account. The other difference is with the sales, these immediately go to the inventory and cost of goods sold entry as well. So what that means is when you make a sale, you actually have two different entries going on. You have your sales price itself and your underlying cost, debiting cost of goods sold, crediting inventory to reduce it, to use it up. So the purchase, we're going to see the same basic entries as before, except we don't use a purchase account. It all touches inventory. So if we purchase 2,500, we would debit inventory to add it in to that asset for 2,500. We would credit cash or accounts payable, however we're paying it. In this case, probably accounts payable. If we return inventory, we would debit cash or mostly accounts payable for 500, and we would credit inventory to reduce it by 500. And if we had a discount, it would be the same as before. We would debit accounts payable for 50, credit inventory this time for 50 instead of that separate purchase discount account. Now for purchase freight, again, the same pattern holds true. We're actually debiting inventory to put that freight cost directly in there, and we'd be crediting, in this case, cash because we paid cash. We could still calculate net purchases, but it wouldn't serve nearly as much of a purpose because this amount is already in the inventory account. There's no need to report it separately. There's no need to do this calculation to see what's going on. We don't need to make a journal entry because we've already been making the journal entry to the inventory account. Now, as I said earlier, the actual amount of cost of goods sold, even though it was given to us early on, the actual amount of ending inventory and cost of goods sold depends on what method is used for inventory costing, whether it be FIFO, LIFO, weighted average. This is all covered in one or more later lectures. That gets a little more complicated there, a lot more calculation, but certainly that's important as well. So hopefully this discussion has helped to further clarify the perpetual versus the periodic inventory system, specifically what journal entries are required under each method. So thanks for your time, and I will talk to you in our later lectures.